Hello everybody, welcome to the core content lecture. This one will be focusing on proper trade management and risk allocation. So getting started with partial profit taking and trailing stop. So before entering a trade, you should already have a predefined take profit and stop loss. Initial stop loss placement should act as an invalidation level for a particular trade idea, and initial take profit levels should act as the best case scenario for a particular trade idea. So now let's say that you are entering a trade, so you have your entry, you have your stop loss, and you have your target. So let's say you're targeting a 1 to 2 risk to reward, so your entry and your stop, the difference between that, your target is twice of that. So I know a lot of people get tripped up on how they should properly take partials and when they should move their stop and trail their stop. So the most optimal area to take a partial at is, let's say like in this example, you're targeting a 1 to 2 risk to reward. So this would be the highest echelon of your target. The best place to take a partial is once price breaches halfway from your target to your entry. So where price would technically be at a 1-to-1 risk reward, you're looking for, if you were bullish, old highs and old fair value gaps that are in between from the halfway from your target to your entry and the full target itself. So within this range right here, this is where you are looking to take a partial. Now it's important to keep in mind you don't want to cut off half of the position whenever you're taking a partial. It's best to take off about 20 to 30% of the position, because if you take off half, immediately as soon as price trades half from your target to your entry, then you will skew the risk reward over time and you will actually cause more damage to yourself if you have a lower hit rate. But if price were to trade through the halfway point of your target and your entry and you took a partial at an old high or an old fair value gap, the only time you are permitted to actually move your stop loss to break even is once you take that first initial partial. Not only does this help manage risk a lot and prevent you from taking unnecessary losses with moving your stop loss to break even, but the importance of moving it to break even after you take a partial is it helps a lot with your psychology if price were to return back and trade and hit you out at break even, because you already took something out of the market, so you won't feel the need to go back in there and get something, as well as you won't feel quote unquote betrayed by the market. And generally once price breaches halfway from your target to your entry, if it rolls back and hits you out at break even after you move your stop loss to break even, more times than not it will likely invalidate the trade as a whole. But even though you were wrong, you were still right. So that is why partial profit taking and proper stop trailing is extremely important. You don't want to do it too early, as well as that you don't want to do it too late. So the sweet spot is waiting for price to breach halfway from your target to your entry. Look for old highs and old lows, as well as for value gaps. Take off about 30% of the portion of the position, and then that's when you're permitted to move your stop to break even, and then allow the trade to ride to either your target or just hit you back out at break even. All right, mitigating losses. So when you take a loss, the best thing to do is de-risk for your next trade. And the amount to de-risk is half of your initial risk tolerance. So let's say on one trade you risked $1,000 and then you lost that $1,000. On your next trade you want to risk $500. So you're risking half of what you lost on that previous trade. Your objective is to only get half of your loss back. As soon as you get half of the initial loss back, then you are permitted to return to full risk. So this is what I mean whenever I say I take 1 to 2 trades a week. If I take one and it's a winner, then I usually don't do anything else for the rest of the week. But if I take a trade on a week and then it turns out to be a loss, on that next trade, I'm only risking half of what I risked on that previous trade. And if I get half of that trade back or half of that loss back, then I'm just calling it a week there. And if that second trade loses, then I'm just calling it a week. So if you take 1 to 2 trades a week, 1 to 2 trades a day, 1 to 2 trades a session, this is the proper way to go about taking quote unquote 1 to 2 trades. There's no real reason to take another trade after you take a winning trade, whether it's 1 trade per week, 1 trade per day, or 1 trade per session. The only time you should really take a second trade is to try to get half back on a previous loss. And the reasoning behind that is the monthly goal. So an amazing goal is to target 6% per month. So this would be, in theory, 1 to 3 risk to reward trades per month, or 3 1 to 2 risk to reward trades per month. I know it's not a lot. It doesn't sound like a lot. You're probably thinking, oh, it can't be this easy, but I promise you, less is more. Once you start waiting for proper trade setups to play out, and once you really become patient, you'll see that some weeks you don't even need to take a trade. And more times than not, you'll be waiting instead of doing something. And that's the proper mindset that you want to be in. But if we take a look at the static rate of return, if you were to target 6% per month for an entire year, that would be a 72% rate of return. So you would make 72% on the year. If you were to, let's say, have a $100,000 account and you were to risk $1,000 per trade and then go for those 2 1 to 3 risk reward trades per month. And I know not every month you're going to be perfect, but that's fine. This is just the hypothetical to allow you to see the grand scheme of things. But that would be 72% per year. That is better than every single firm. That outpaces a lot of people if you just go for 6% per month. And I believe that's a pretty achievable goal, especially once you get to a point to where you really know what you're doing. Now, on top of that, if you compound that 6%, it would turn to be a 101% return. So if you had a $100,000 account, if you were to compound your 6% per month, you could make $100,000 that year. Now, compounding is a little bit more difficult just because you're adding a little bit more risk after every single winning trade. But compounding is pretty much, let's say, again, you're risking $1,000 and you have a $100,000 account. After you take a win, and let's say you're going for a 1 to 3 risk reward, now your account value is at $103,000. So then on that next trade, you're risking $1,300, compounding on that previous win. So if you take everything slow and steady and you really wait for high probability scenarios, and you aim for 6% per month, and you just compound that throughout the entire year, whether it's a static rate of return or a compounded rate of return, you are outpacing pretty much every single other trader by either 2 trades per month or 3 trades per month. So hopefully y'all found this one insightful. I will speak with y'all again soon. Good luck and good trading.